Hello again. In this video we're going to explore using a very underutilized mechanism to reduce or avoid inheritance tax, which is GNIs, or gifts out of normal income. Now, as it says, it's gifts out of income, so what you can't do is gift regular capital other than your 3,000 a year annual allowances and expect that to be outside your inheritance tax. However, if you've got any form of income, and how would you know if it's income? Well, it's liable to income tax on your tax return. So earnings from any work you do, rental income, dividend income, any income that you pay income tax on, very, very simply, is allowable. So pension income, even if you're in retirement already, also counts. So if your overall income exceeds your expenditure, and it's possible to prove, or your executors to prove, that the amount that you were gifting every year had no real negative impact upon your standard of living. I know that's a very loose and subjective measurement, but that's what the rules say. So effectively one can set up a gift out of normal income. Now, it's imperative in this scenario to properly record what you intended to gift and what you gift every year. And we again always advise clients to properly draw up a document which is signed and witnessed and kept with their wills and trust document to identify exactly what this gift was, what the reason is, the amount of it, and have some sort of proof that the gift is being made. So in an ideal world, we help you draw up a document as to what you want to gift. Obviously, it's about looking at your income and expenditure and what applies, and then deciding if this is a reasonable strategy for yourselves, and then making those gifts regularly going forward, and what the value of those gifts and how much, and then properly recording it and making sure that it comes from a bank account on a regular basis, so that the trail of money is easily recorded and provable by your executors in order to claim the exemption for inheritance tax purposes. So one of the major benefits that we advise clients to think about is that, potentially in conjunction with talking to our preferred regulated financial advisors, is that you can potentially give money using this methodology to your children, and providing they have the allowances, place it into their pension funds. I recall one client saying to me quite specifically he didn't want to fund his children's champagne lifestyle, for want of a better expression, and I can see his perspective, but nonetheless they did have a fairly significant income level over and above their effective expenditure, so it made sense for them to talk to our regulated partners and ensure that their children had good pension plans in which they could contribute into on a regular basis, knowing that those children couldn't access that money until at age 55 at earliest, by hopefully which time they are at least financially sensible. It's a methodology of making use of tax allowances, and even more importantly, if people's children are non-taxpayers, for maybe they are not working mothers or whatever reason, or low earners, and just as importantly if children are high earners, because obviously any contributions that are being made into pensions reduces tax, and at 40% at this moment for higher earners. So a very, very good form of saving inheritance tax on the one hand, and also potentially children income tax on the other hand, depending upon the scenario, but another reason to refer you to our regulated partners for the best advice in this specific area. But if you wanted to just make a regular gift, let's say to your grandchildren, you could potentially, if we'd set up a grandchild's trust, make regular gifts into that, and that would be exempt and it wouldn't become a chargeable lifetime transfer because it's utilizing this particular rule. So effectively you could even make a gift into a trust using this mechanism, because the problem, as I said, is making gifts into trust is if they're chargeable transfers, then every 7 years you don't want to make any more. But usually speaking, we would place it into a plan. If you wanted to do it for grandchildren's education fees or whatever, we could put it into separate plans, which you know when it's going to come out, and that would make sense as well. So gifts out of normal income, as I say, really vastly underutilized to my mind. One classic case we had was a client who was, when he was working, a senior director of a FTSE company, and his pension was over £150,000 a year. And we made quite a significant gift every year to his children from his income stream, and it was easily provable and had immediate inheritance tax advantages in that it falls out of the estate the day that you make the gift. So well worth looking at, very, very useful for those people who are income rich and make sense in terms of overall inheritance tax planning. So that's gifts out of normal income.